What's going on, everybody? It's Jeff here. Welcome back to the channel. All right, guys, I explained to everyone why I believe the stock market was at a bit of a turning point. We are still in that consolidation period. However, tomorrow, the FOMC blackout period begins. A blackout period is a small time frame in which Fed members are not allowed to speak to the media, give their opinions or insights on how the Federal Reserve should react to a certain issue. Reason why this is good for the markets is because investors like calmness. There's going to be no hearsay, no conspiracy, no opinions in what the Fed should do, freaking out investors going forward. We have a very, very small time frame, as well as earnings are set to continue. Now, yesterday, Netflix pulled hard. If you look at how the market reacted today, the Dow was great, the S&P was average, small caps were pretty flat as well. But if you look at that NASDAQ, down 1.2%, and it was really Netflix that just pulled the entire tech sector down. They've lost subscribers. They are trying to actually run ads, and they are struggling being a single dimension business. However, just a few moments ago, Tesla did report their earnings. They're up 80% year over year growth and positive across the board. The after hours chart is a little bit choppy right now as everybody awaits for Elon Musk and his entire executive team to give guidance for the rest of 2022. I am always looking forward to, especially when Elon says he was going to be on this meeting. But let's get back into what I was talking about besides the FOMC blackout and a couple things I really want to mention. If you take a look at the SPY chart, I'm going to zoom out just a little bit for everybody. I do still have some lines drawn here from today's trading day. We are stabilizing in this W formation. Held support very well off this 436, 437 area. As we zoom in, it did start to break out a little bit as we eventually hit that 447 bit of resistance. But here's what I want to talk about outside of looking at a chart, because I know I go through technical analysis a lot. Couple things here. The 10-year treasury has bounced off this 3% mark. It's elusive 3% mark that was heavy resistance. And there's a couple things I was reading as of recently, and I want to point this out to everybody, just how fast the 10-year has risen. Now, going back, and this is over a 5-year time frame, anytime the 10-year has risen dramatically, which is in early 2021, which is really the only time, it tends to pull back a little bit. The 10-year and just all treasury yields do not really explosively gain traction. They don't really hit breakout levels to where they continue to fly like you'll see small caps or stocks do. Okay, it really tends to pull back and stabilize, and it moves a little bit slower. So seeing this massive growth all the way from about a 1.67, 1.68 area just pretty much a little over a month ago, and all the way up over about 40 to 50%, it is due for a bit of a pullback, and it already has from that 3% range. That is the first thing. The second thing, which has to still do with the Federal Reserve, is the amount of rate increase investors are pricing in. I was talking about this with everybody inside the group, and if you look at where the investors are expecting funds to go as of the May 4th meeting, it is expecting 93% saying that they're going to raise 50 basis points, which is completely on track. And I expect them to do that as well, especially because April inflation numbers, which UBS does predict them to be down a little bit, are not going to be out until the 11th. But if you scroll forward a little bit to June and July, there are still pricing in another 50 basis point hike. And if you look at 51% at 125 to 150 and 45% at 150 to 175. Now, here's the thing, because like I explained this just earlier, investors like certainty. So even if we do hit that 50 basis point hike, okay, in May, and we do get another 50 basis point hike and we get to that 125, like 150 area, it's still going to provide, surety that they're not going above and beyond. It's not going to be out of realm. And the market tends to price this in. And it's the same thing. Go out to July and you can look even further. July is pricing in pretty much another 50 basis point hike, which means if you break those down to naturally one hike equaling 25 basis points, that's 6 hikes in the matter of 3 months. And when you looked at Goldman Sachs saying and JP Morgan saying they expect anywhere between 6 and 8 hikes throughout the year of 2022, seeing that 50 to 60% of the entire market is literally pricing 6 to 7 hikes in already by July. I think we're a bit too far on one side of the spectrum, especially because UBS has predicted that inflation is going to start coming down a little bit. We've already seen the price of the pumps, even though it's just a little bit, come back down. Crude is sitting anywhere between that 95 to 105 area, kind of fluctuating in between, down from $130 a barrel, as well as other, sectors such as the used car industry, okay, that is starting to pull down just a little bit. And because those numbers were so inflated for so long, seeing the year over the year just decline a little bit really gives room to say that investors might be pricing this in just a bit much. You also have to go into fact, I'm going to continue to say this to everybody, there is a lot of money on the sidelines. And considering that this 10-year is just under 3%, inflation is still much higher than this number. Where is all that money going to go? Cash is losing value every single day. Netflix alone dropped 35%. That's about $50 billion worth of valuation that was taken away from Netflix that really needs to be rotated into something else. So first up is going to continue to see how Tesla reacts. If Tesla continues to provide positive guidance, which by the time some of you are watching this video, they're already going to do or not do, it's really going to give direction to the market in either way. When you zoom out just a little bit to this SPY chart, I'm going to zoom in from where we were, but zoom out to the 1 hour chart on the 30-day, you can see this 447 level is a key for a nice breakout to the upside. You can see we came down, we had a little bit of descending channel, and we're starting to break this descending channel that we just had right here. So like I said, seeing those all-time highs, I am still bullish that we will retest that all-time high on the SPY, which is almost at that 480 level by the end of the year. I did not think we were completely at a downside of this 410, but it looks like we might just be for the short term. Now, when everybody is talking about all, on YouTube videos, instilling fear and what's going to happen and panic, just remember, okay, when everybody is flowing in one direction, that's when the market makers and investors really tend to pull you in the other direction, okay? Now, I do not think a recession is out of the question, but just remember that stuff is going to happen in 2023 to potentially 2024, right? Like some economists think, but we're here in the short term. We need to think about the next 6 months before we can think about 2 years, all right? So guys, that's it for this video. I'll see you in the next one.